Welcome to the Week 1 material. Today we have a number of topics to talk about, and what we're going to do is we're going to start with a discussion over current liabilities, some of the types of current liabilities that you may see on your company's balance sheet. Then we'll move into a conversation on some of the longer term liabilities. We'll talk about contingencies, both gain and loss contingencies. We'll talk about warranties, gift cards, and loyalty programs, which are all types of liabilities that you may see either in long-term or in short-term. And then we'll end today's discussion with an overview of long-term debt, and we'll cover both bonds and notes payable. So before we really get into a discussion tonight about the different types of liabilities, it's important first to make sure that we understand what a liability is. And so the definition really of a liability is that there is a probable future sacrifice. And that probable future sacrifice primarily is going to be an outlay of cash, but it doesn't have to be. And it needs to arise from a present obligation. So some transaction or some event has happened that now requires you to pay out cash or some other type of economic benefit. So it arises from a present obligation of a particular entity to transfer assets, aka cash, or provide services to other entities in the future as a result of a past transaction or event. So when you think about whether or not you have a liability, there's really kind of three kind of things to think about. The first is that there has to be a settlement, of goods or cash or services. And so when you think about that, think about you buy something on account, right? You have bought, the transaction has occurred, and you have a future obligation to pay whatever company it was that you bought those goods on account from cash. Additionally, or think about it differently, let's say that a company prepays you a sum of money to provide, ongoing maintenance for the next year, right? So you're not actually going to be paying out cash in the future, but what you are going to be paying out or providing in the future is a service, and that is, the ongoing maintenance. Additionally, a liability is created when there's an unavoidable obligation. And when you think about an unavoidable obligation, this really centers around you're legally or contractually obligated to pay or provide a service. And when you think about a contract, it doesn't necessarily have to be written. It also could be a verbal contract. And then the final component of the definition of a liability is that the transaction or event that has created this obligation has already occurred. And if the event has not occurred, then it isn't a liability as of the balance sheet date, but what it could be is a subsequent event, which would be also reported in the footnotes, but not necessarily as a component of the balance sheet. And we'll talk a little bit more about subsequent events in a future lecture. So when it comes to what is defined as a current liability, we need to first take a step back and think about what the definition of a current asset was. So if you think back to Accounting 310, a current asset was cash or some other asset, could be accounts receivable, it could be inventory, it could be prepaids, that a company reasonably expects to be able to convert into cash, to sell, or to consume in the operations of its business within either a single operating year or a calendar year, whichever happens to be longer. So in defining a current liability, it's really based upon the definition of a current asset. And so when we think about current liabilities, those are obligations whose liquidation means settlement, whether that be settlement in cash or settlement in terms of providing a service, is reasonably expected to require the use of existing resources that are classified as current assets. Or alternatively, they could also create other current liabilities. So the easiest example that I can explain for this is if we go back to buying goods on account, right? We buy goods on account, we create a liability that is accounts payable, and then 30 days, 60 days later, we pay off that accounts payable, usually with cash, and because cash is classified as a current asset, that means that the accounts payable is also going to be classified as a current liability because we're using a current asset to liquidate that liability. So it's also then important to note that the distinction and the interrelationship between current liabilities and current assets is how we arrive at either a current or the quick, which is also known as the acid test ratio. And it's important to understand the distinction between current liabilities and current assets because it helps us calculate how liquid the company is. It's also important that we be able to distinguish between current liabilities and long-term liabilities, which is primarily long-term debt, because long-term liabilities are not included in the current or quick ratios. Now, when it comes to liquidity of a company, a more liquid company is better able to withstand a financial downturn and has a better chance of taking advantage of investment opportunities that may come about because they have more assets on hand that can quickly be converted into cash. So if we take a look for a minute at what the current ratio is, it is expressed as a coverage of X amount of times. And it's calculated very easily. You're going to take your total current assets divided by your total current liabilities, and both of those subtotals should be on the face of your balance sheet. Sometimes you may also hear it referred to as the working capital ratio because working capital, the definition of working capital, is the excess of current assets over current liabilities. Now, alternatively to the current ratio, there's a second ratio that's called the quick ratio or the acid test ratio. And this ratio is a modification of the current ratio, and the reason for it is in the calculation of the current ratio, that ratio includes in the numerator, the current assets number, assets that are tied up in inventory, which could be slow moving, and prepaid expenses, which are not going to be turned into cash. So the quick or the acid test ratio basically takes your cash plus any marketable securities that you have on your balance sheet, as well as your accounts receivable balance, and divides that by your current liabilities. And so what you'll notice is in the quick or acid test ratio, you leave out both inventory and prepaid assets. And because the purpose of the quick or the acid test ratio is to determine how well a company's assets can cover its liabilities, prepaid assets are assets in which cash has already been paid out in exchange for a future service or supplies on hand or a lease, or there's a variety of different options that a prepaid asset can represent. However, regardless of whether you have supplies or a prepaid rent or a prepaid insurance contract, any of those are not going to be able to be turned back into cash. And as a result, then, some argue that it's best to leave those out of the quick or the acid test ratio because since they can't be turned back into cash, they can't be used to help cover your existing liabilities. Additionally, inventory can be a difficult type of asset to turn into cash quickly because it could be obsolete, or if it's sold on account, then instead of cash being generated or created, accounts receivable is generated, and then that accounts receivable has to be collected in order to generate any cash. So some argue that the quick or acid test ratio is a better ratio to use because it's a more conservative calculation to check to see how liquid your company is. Now that we have a good understanding of what current liabilities are, let's take a look at what are some examples. So I already mentioned earlier accounts payable. There's also notes payable, current maturities of long-term debt, short-term obligations that are expected to be refinanced, dividends, customer advances and deposits, unearned revenue, sales tax, income taxes, and employee-related liabilities. And we'll take a closer look at some of these in the next coming slides. So one of the things that I want you to take a minute and look at is the face of your company's balance sheet for the SEC 10K project. And I want you to look at what types of categories are in current liabilities for your company. And every company is going to have a slightly different mix of current liabilities depending on the industry in which they operate. So I want you to take a look at yours and see if you think it makes sense given the industry in which your company operates. So here's a quick example of Hormel's current liabilities. And so what you'll notice is by far and away their largest liability is accounts payable. And so you might ask yourself, well, does this make sense? So let's first think about the business that Hormel is in. So Hormel is primarily a manufacturing company as well as a merchandising company. So if you recall, a merchandising company buys and resells goods, and therefore it would make sense for a merchandising company to have a significant accounts payable balance because they are buying goods from manufacturing companies and then reselling those to the public. So their accounts payable then would represent all of the money that they owe to the manufacturers who sold them products. Now, a manufacturing company could potentially also have a significant amount of accounts payable for the raw materials that are needed to manufacture their items. So it doesn't seem all that unusual to me that accounts payable would have a very large balance within the current liability section. You'll also notice that Hormel has some short-term debt. So this represents debt that is due within 1 year or the operating cycle. In this situation, it would be 1 year because Hormel's operating cycle is about equal to 1 year as well. They also have a number of accrued expenses. They have some accrued workers' compensation. So Hormel is a manufacturing company, right? They have a lot of employees that work in factories, and so, factories can sometimes be dangerous, and so it doesn't surprise me to see that they don't have a liability for workers' compensation, either for injuries that have already occurred on the job or injuries that they think are going, or additional payouts that they think they're going to have to pay for injuries that maybe have not yet been, that have happened, but that have not yet been fully through kind of the process. You'll also notice that they have a very large employee-related expenses liability. So this would represent accrued vacation, accrued sick time, maybe wages that had been earned but not yet paid out. So that is another large balance that Hormel has on their balance sheet. They also have a small taxes payable account, and then interest and dividends represent a very small component. So the last item on here that I just want to point out, which is a little unusual, is the accrued marketing expenses. So, that may or may not kind of resonate quickly with what that may mean to you. For me, it certainly didn't. And so one of the things that you're able then to do is to kind of look within the footnotes for a little bit more information about what that represents. And so the excerpt off to the right explains that they offer, coupons and incentives to people to buy, Hormel's products, and then they have to basically accrue or record a liability for the future amount of money that they think they're going to have to pay out for people who redeem those coupons, whether that's rebates back to the ultimate consumer or money paid to grocery stores for coupons that were redeemed in stores. It also represents, the fact that they have marketing campaigns on TV, news, print, and radio. And so this paragraph over the right sort of gives you a little bit more clarity and detail about what that represents. So accounts payable, probably almost every company is going to have this in some shape or form. You also may hear it referred to as trade accounts payable. And what accounts payable or trade accounts payable relates to is money that's owed to others for either goods, supplies, or services that were purchased on account. And what this really represents is the time lag between the receipt of the services or the goods and the payment for them. It's important also to consider when we're thinking about the topic of accounts payable, when we actually have a liability or an obligation on our balance sheet. So a company needs to record the liability for purchases of goods or services when the goods are received, which typically is represented by FOB destination, or when legal title is transferred. This is really important, especially near the end of an accounting period, to determine whether or not inventory and the associated liability should be included in the financial statements. So if the terms of a purchase are FOB destination and this pallet of widgets arrives at your dock on December 31st with the terms of FOB destination, as of the end of the year, you should record a debit to inventory and a credit to accounts payable because you are obligated to pay for those goods as of the balance sheet date, which is 12/31. Now, contrary to that example, let's pretend that the shipping terms are FOB destination, but they don't arrive at your dock until 1/1 of the following year. If that's the case, then you were not legally entitled to record those goods on your financial statements as of 12/31. And then as just a final side note, also remember that there's another type of shipping term, and that is FOB shipping or free on board shipping, and that is when title transfers once the goods have been shipped. So it's important to make sure that you understand the difference between those two. So if we move on then to notes or to loans payable, a note or a loan is a written promise to pay a certain sum of money on a specified future date. Notes or loans payable can arise from purchases, from financing, or from other transactions. Usually a note or a loan will generate from a bank. Usually banks are the ones to be giving out loans and notes, but it doesn't have to be. And then within the terms of the note or the loan, it can be either an interest-bearing or a zero interest-bearing note. And we'll go through an example of each of those in just a minute. And then off to the right, you can just see a quick picture that kind of shows you the life cycle of a note. I do just want to take a minute and point out that notes payable and notes receivable are really the same thing. It's the same instrument. The only difference is that for the borrower, so the one who is receiving the cash, they are called a note payable. And for the lender, the person who is giving the money, they are called notes receivable. And it's also important to note that notes payable and accounts payable are not the same thing. Now, it is possible for a note payable or a note to be signed to finance the purchase of inventory or the purchase of services, but generally they are used for other purposes, to provide an influx of cash, maybe for an expansion or, to get a business off the ground, and they tend to be much longer term in nature than accounts payable. When we think about accounts payable, most accounts payable, is paid within 30 to 60 days. So now let's take look at an example of an interest-bearing note. So Pepsi issues a $100,000 note on March 1st of 2015 to Fanta for 4 months at a 6% annual interest rate. So if we just stop there for a minute, Pepsi is the lender and Fanta is the borrower. We're also told that financial statements are prepared quarterly using a calendar basis, and interest is paid either the earlier of the note maturity or annually. So the first journal entry that we need to book for this, and we're going to book these journal entries as if we are the borrower. So we are Fanta. So we are going to receive an influx of cash. The cash that we are going to be receiving is the face value of the note, which is $100,000. So we are going to debit cash for $100,000, and we are going to credit notes payable for $100,000. Now in this situation, since this note is only for 4 months, this note payable would be classified as a current liability. On March 31st, 2015, it's time for us to prepare our quarterly financial statements. Okay, and so we then need to record an adjusting entry to accrue for the interest that has been charged on this note for 1 month. So we are going to debit interest expense, and we're going to credit either accrued interest or interest payable. They're the same thing. I don't care what you used, and depending on companies, they use these terms interchangeably. We also need to be able to calculate the amount of interest that is owed. And so what we're going to do is we're going to take the face value of that note, which is $100,000. We're going to multiply it by the interest rate, which is 6%. Keep in mind that this is an annual interest rate, and we're only recording interest for 1 month. So we're going to multiply $100,000 by 6%, and then multiply that by 1/12. And that gives us $500 of interest. Okay, now when we move along and we get to June 30th, we have another entry that we need to record for interest. So that is going to be very similar to the previous calculation, except that instead of 1 month's worth of interest, we are going to record 3 months worth of interest. So we're going to debit interest expense for $1,500, and we're going to credit accrued interest or interest payable for $1,500. And then finally, on June 30th is also when the note matures. And so what we're going to do is we need to pay back the note. So we are going to credit cash. We're going to debit our notes payable, and then we're going to debit our accrued interest or interest payable account. So the total amount of cash that we owe back is $102,000, and that represents the original value of the note plus all of that accrued interest that has happened over time. Next, let's take a look at a zero interest-bearing note. So this type of note does not explicitly state an interest rate on the face of the note, but interest is still being charged by issuing the note at a lower price than its face value. Now, at the maturity then of this note, the borrower is going to pay back an amount greater than the cash that they received at the issuance date. And so what happens in this type of arrangement is that the borrower is going to receive the present value of the note. And in these situations, the bank is actually taking its fee or the amount of interest that it wants to earn over time at the beginning of the note versus receiving it at the end or at the maturity. So in this situation, Sprite issues a $102,000 4-month zero interest-bearing note to Dr. Pepper. The present value of the note is $100,000. So in this example, Sprite is the lender, Dr. Pepper is the borrower. The face value of the note is $102,000, but the present value is $100,000. And so what our journal entry is going to be, and again, this is from the perspective of the borrower, we're going to debit cash, and instead of getting the 102, we only are going to receive the present value. So we're going to debit cash for $100,000. We're going to credit notes payable, and at the end of this 4 months, we owe the face value of the note back to Sprite. So we're going to credit notes payable for $102,000, and then we don't have a balanced journal entry, so our last component is going to be a debit to discount on notes payable for $2,000. Now, discount on notes payable is a contra liability account, so when you present this issuance of the bond on the statement or the balance sheet, you're actually going to net your notes payable and your discount on notes payable together and present that as a net number. So you're actually on the balance sheet going to see that note payable valued at $100,000. Now, you might be asking yourself, well, if this is a zero interest-bearing note, then why am I, being charged interest? And the reason for that is you can rarely, if ever, borrow money for free. Why? Because there's always an opportunity to invest the money in something else and earn interest. And that's the time value of money concept that you learned in Accounting 310. So if we now take a look at what I indicated earlier about how it would be presented on the balance sheet, you'll notice that what is presented on the balance sheet is going to be $100,000. Okay. Additionally, since this note is going to mature in 4 months, it is properly classified as a current liability. Okay. And as I indicate on the slides, this discount on notes payable really represents interest expense that is going to be charged in future periods. And we'll take a look at how that's going to work in just a second. Okay, so similarly to when we were doing the interest-bearing note example, okay, 1 month in to our into our zero interest-bearing note, we need to record some interest expense. So we are going to debit interest expense for $500, and instead of crediting accrued interest or interest payable, we are going to credit the discount on note payable, which is simply reducing its balance slightly. Okay, at the end of the 4 months then, we're going to have debited interest expense for a total of $2,000. The discount on the note payable balance is going to be zero, and the note will be paid back to the lender in cash for $102,000. Next, let's move along and talk a little bit about current maturities of long-term debt. So, current maturities of long-term debt are the portion of a bond, a mortgage note, or really any other type of long-term debt that is going to mature within the next fiscal year or operating cycle. It also includes any liability that is due on demand, which is also referred to as being callable by the creditor. And how this works is that if you are in violation of your debt agreement, then the lender is able to call your debt at any time, and therefore you're required to list it under current debt or current liabilities. Now, there are a few situations in which you are going to exclude considering your bonds or notes or other indebtedness as a current maturity. And that is if your debt is retired by assets that were accumulated for this purpose and that have not been shown as current assets. So an example of this was if you were going to retire your debt by exchanging it for some fixed assets, which we know fixed assets are a long-term asset, then you would not show your debt as current. Or if you were going to refinance or retire from the proceeds of a new debt issuance. That also would not be classified as a current maturity. And then finally, if you're going to convert your debt into capital stock, and we'll talk about convertible debt in week 2, but if you're going to convert your debt into capital stock, that's another example of why you would not consider it to be a current liability. And the underlying reason for all of these is that you don't want these to be considered current liabilities because they are not going to be using current assets or creating other current assets. They're not going to use current assets or create other current liabilities, and that is the entire definition of a current liability, if you go back to slide 4. So because none of those 3 situations are creating new current liabilities or using up a current asset, they should not be classified as current liabilities. Sometimes we might have a short-term obligation that is expected to be refinanced. So as an example, what happens if we have a company and they have a 5-year bank loan, but they handle the actual financing with 90-day notes that they keep renewing? So the question then is, well, it's a 5-year loan, so that would be considered long-term. But if we're financing it with a series of 90-day notes, then maybe that should be considered current. And so the rules say that you are going to consider it to be a current liability unless both of the following criteria are met. First and foremost, the company must intend to refinance the obligation on a long-term basis. And secondly, the company must demonstrate an ability to consummate the refinancing. So when it comes to intent, the company must intend to refinance the short-term obligation so that it will not require the use of working capital during the next year or operating cycle. Okay. And what this really gets down to is, what is the cash being used for, right? If it's being used for a capital expenditure product, a new product line, a new warehouse, a new building, right? Or is it being used to buy new inventory, to buy office supplies, okay? If the intent is for long-term purposes, then that is one of the 2 criteria that is met then to be able to consider it long-term. The second criteria comes with ability, and that is demonstrated either by actually refinancing the short-term obligation, by issuing a long-term obligation after the balance sheet date but before the issuance date. This is known as a subsequent event. Or by entering into a financing agreement that permits the company to refinance the debt on a long-term basis. Now, in my experience, I have not seen where a company has this type of arrangement. But what I want you to focus on not so much is the rules, but is kind of the thought process about how they came about, whether it's considered short-term or long-term. Okay. Dividends are also a line item that you may see. When it comes to dividends payable, these must be in cash. So this is the company paying out a cash dividend to its shareholders. Usually this will arise when the board of directors authorizes a dividend, and on the date of declaration is when the company assumes the liability that places the stockholders in the position of creditors and the amount of whatever the dividend declared is. Typically, dividends are going to be classified as current because the payment is going to occur usually within 3 months of declaration. Now, there's also types of dividends that are not in cash. Those are stock dividends, and those will be discussed in next week's lecture. But they don't require the future outlay of assets or services, and thus they're not going to show up on the balance sheet in the current liability section. Instead, they're going to be reported in stockholders' equity. Now we're going to talk a little bit about customer advances and deposits. So a deposit is received from a customer to guarantee performance of a contract or a service, or to guarantee to cover payment of expected future obligations. So a really good example of this is you're getting married or you're having a big party and you have to put a deposit down on the venue. Okay, and so that kind of secures your spot, and the company that you're contracting with doesn't need to record that as revenue, right? Instead, it's a deposit, a liability on their books, because now they're obligated to provide you a future service or good, aka the wedding venue or the party venue, on the date that you have agreed upon. Now, whether or not a customer advance or deposit is considered current or non-current depends on how long of time is between the date of the deposit and the termination of relationship requiring the deposit. So that really gets to when is the date of your event, right? If the date of your event is within the next year, then it'll be current. If it's not until 2 years from now, then it'll be long-term. This is just an example of Marriott declaring a cash dividend. And so what you'll notice here is that today they announced that their board of directors declared a quarterly cash dividend. It was 41 cents per share of common stock. The dividend is payable on March 29th, so that is the date that the shareholders will receive their payment. And it is to shareholders that are on record as of March 1st. And next week, when we talk a little bit more about dividends, I'll explain the difference between those dates. Now, depending on your company, there are a ton of different types of unearned revenue. And unearned revenue generally represents money that is received from customers in advance of delivering goods or providing a service. So unearned revenue is a type of customer advance or deposits. So every day we're doing things that result in companies having to record unearned revenue. So for example, you might purchase an airline flight 6 months before you actually are going to fly. You might pay for an entire year's worth of a magazine subscription, and that magazine company now has an obligation to send you a magazine every month for the next 12 months. Additionally, you may buy a gift card to give to someone or even for yourself to use at a later date. So when a company sells a gift card or a magazine subscription or sells you an airline ticket, they are going to record cash, and then they are going to credit an unearned revenue account, which is a type of liability account. And then, once that revenue is earned, and we will go over revenue recognition in week 3, once that revenue is earned, they are going to debit the unearned revenue account, and they are going to credit sales revenue. Now, depending on the type of industry that your company operates in, there are different types of unearned revenue. And this is just a very short list of some of the different types of unearned and earned revenue that you may see depending on the industry in which the company operates. So next we're going to move on to sales tax payable. So most companies are required to collect sales tax from customers on the transfer of tangible personal property, aka buying stuff, and on some certain services, and remit those taxes to the proper government authority. Now, that government authority could be state government, could be local government, could be city government, it just depends. And so, we're just going to go through a very, very brief example. So, you go to the store, you spend $3,000 in a jurisdiction where there's a 4% sales tax. And so, you as the customer are going to pay $3,120 for that total transaction. So whoever the company is that's selling you those goods is going to receive that cash of $3,120 or record a debit to accounts receivable. They're going to credit sales revenue for the amount of the sales revenue component only, which was $3,000, and then they're going to credit sales tax payable for $120. Now, when they remit payment to the taxing authority, they're going to debit that liability, and they're going to credit cash. Now, the frequency on the subsequent payment of the taxes collected depends on the state tax laws and the volume of sales by the seller. Typically speaking, and this is very general, right, the higher volume and the higher dollar value of sales that you have, the more frequently you are required to remit those taxes to whatever the applicable jurisdiction is. Okay. Now, on a similar tax-related line item, there's also income taxes payable. So companies, now not partnerships, but C Corps, must pay income taxes on their earnings to both the federal and the state government. And so they must compute their income taxes payable resulting from their operations in the current period. I mentioned before, this does not apply to partnerships or to sole proprietorships, which are pass-through entities, but the liability is created by debiting your income tax expense and crediting your income tax payable. And then similar to individuals who can elect to pay estimated tax payments throughout the year, although most individuals have taxes withheld from their weekly or bi-weekly or monthly paychecks, companies are required to pay periodic tax payments during the year. Typically, they're paying those payments quarterly. And so we will talk more about accounting for income taxes in week 5 of this class. Now, another really big item on the balance sheet, especially in the current liability section, is employee-related liabilities. And so there's a variety of different types of employee-related liabilities that can arise. So we have the amounts that are owed to employees for salaries and wages at the end of the accounting period. So most people get paid weekly or bi-weekly or twice a month or once a month, right? And so oftentimes there's a time lag between, the work that you have completed and when you actually get paid. And so that time lag represents a liability to the company because they are obligated to pay you. On top of paying you, they are also withholding taxes out of your paycheck and also contributing a component or a portion of their own for Social Security taxes, so FICA and Medicare, unemployment taxes. There's also payroll deductions that may be taken out, for contributions to a 401k or, maybe for a charitable donation. All sorts of different items can be withheld from your paycheck. And so they also need to record liabilities for any of those. Now, we're not going to go through this specific example. It's pretty self-explanatory, but I did journalize for you the journal entries that would be recorded to pay or to record some of these payroll-related items. Now, you may not be familiar with this term, but I'm sure you're familiar with the concept, and that is what is called compensated absences. And those are paid absences from employment, and that may be vacation time that you've earned, sick time that you've earned, holidays, etc. And so a company is required to accrue for the cost of compensation for future absences if all of the following conditions exist. Okay? So first and foremost, you as an employee have a right to receive compensation for the future absences. And this is in conjunction with services that are already rendered. So if you think back to the very beginning of the lecture when I was explaining the definition of a liability, I indicated that the transaction or event had to have already occurred, right? And so this plays very well into that definition. You have already provided the required services to earn that time off. Additionally, that time off has vested or accumulated, and that means that it cannot be forfeited. It cannot be taken away from you. Payment is probable, and the amount can be reasonably estimated. Now, you might say, well, why is there any uncertainty about the amount that can be reasonably estimated, right? So you may earn the time off this year, but you might not take the time off until next year. And between now and then, you might change jobs and get a higher salary. You may just have a merit increase. And so it is somewhat challenging at times to be able to calculate what that value of that liability should be. So we talked about vesting a little bit, that it cannot be forfeited. You accumulated rights, or the rights that an employee has to carry forward to a future period if it's not used in that period. So some companies have rules around how much time you can carry over. Some companies require that you use all of your time in the year that it's earned. So all of those then have impacts on how to actually calculate the liability. And then the last piece is, what rate or what salary do we use to calculate that liability? And so the rule of thumb is to use the current salary, because that is more easily and reasonably estimated or known. So I'm not going to go through this specific example. You can kind of look at it on your own. But this just kind of shows you what the journal entries would look like to accrue for the compensated absences, and then when people actually take their vacation, how the payout would look as well. So that covers our discussion over current liabilities. We've gone over the definition of a current liability is, and we've gone over several different types of current liabilities that you may see on a balance sheet. Now what I want to do is I want to shift our focus over to contingencies. And a contingency is a situation or an event where there is some type of uncertainty about whether or not an obligation to transfer cash or provide some other type of asset has arisen, or the event has happened, but there is uncertainty as to how much will be required to settle that obligation. And that is the definition of a contingency. So some examples of contingencies would be that the company's been sued and there's an outstanding lawsuit, and we don't know what's going to happen because we don't know whether we're going to be found guilty or not, and if we're found guilty, ultimately how much we're going to have to pay. There's also examples like warranties, where you buy a car and the car manufacturer gives you a warranty that they'll fix any problems that arise in the next 5 years. Well, you may or may not have a problem, and that problem may or may not cost a lot of money to fix. And a final type of contingency is when there's a guarantee for a loan for another entity or company. So you sometimes see this, when you're young, you might not be able to go get a car loan on your own. You may need a cosigner, right? And that cosigner is basically guaranteeing that if you don't pay, that they will cover your car payment amount. Now, when it comes to contingencies, we can have a gain or a loss contingency. And we'll talk about each one of those in the coming slides. So first of all, a gain contingency is claims or rights to receive assets, usually that is going to be cash, or to have a liability reduced whose existence is uncertain but may eventually become a valid claim. And the reason for that is either the amount is unknown, or we are not yet sure what the verdict of the litigation that is outstanding may be. So some gain contingencies can arise from, refunds from the government in tax disputes, pending court cases where maybe the outcome is going to be favorable to us as the company. And they also could be receipts of money from gifts, donations, asset sales, etc. Now, gain contingencies when it comes to US GAAP follow a very conservative approach, and that is that we are only going to record a gain contingency when there is a high probability for realization. And it is very, very unlikely that you are going to find information about pending gain contingencies in the financial statements. And the reason for that is you don't see anything about a gain contingency in the financial statements until it is fully settled and the amount is known. And the reason for that is much of US GAAP is based on a conservative model. We don't want to record revenue before we're absolutely certain that we have a right to it. Now, let's take a minute then to go over a gain contingency example. I'm going to give you a minute to read through the example, and then I will provide some additional commentary. Okay, so in this example, right, there's uncertainty about how much money will ultimately be collected by time's up. And so throughout the first 2 years and even into the third year, nothing will be ever put into the financial statements regarding this lawsuit. It will also not be disclosed in the footnotes either. But at the end of year 3, when it is finally settled, there's no more appeals possible, that $270,000 will be recorded as a gain and the collection of cash. Now let's move on to loss contingencies, which are much more likely to be disclosed in the financial statements. Now, loss contingencies are often also called contingent liabilities, and a loss contingency or a contingent liability depends on the occurrence of one or more future events to either confirm that yes, we owe an amount, or maybe no, we don't owe the amount, or there might be some uncertainty as to who we owe, or at what point in time we owe it, or whether or not we even owe anything at all. And so when we look at contingent liabilities, there is a spectrum of likelihood of loss. So on the far right side is probable.